Well, if they don't say it, the bond market will do it for them, Karen. I think is probably the simple answer to the question. Damned if they do, damned if they don't. Supply side has not got better. The US, in terms of the labour market, is on fire. The US corporate sector seem very keen to do an inventory rebuild. And all of this with unemployment sub 4%. And of course, a lot of people choosing to abandon, to a degree, the workforce as well because of the participation rate stubbornly refuses to rise. So you've got a real crunch. And I think the Fed is now just being realistic. It's probably trying to talk down bonds as opposed to necessarily taking the action required. And they're probably hoping that open mouth operations can be helpful to stop a very steep curve. But there seems to be modest suggestions that I guess the supply side eases. And of course, year on year inflation eventually will fade. Used car prices can't go up 30% a year forever. But it's getting sticky. And I think all the Federal Reserve governors are doing is just telling you that. And it goes back to a thesis that it's easy to promulgate, which is sell the pandemic ending. It's pretty clear at this stage, and having had Omicron, I can speak openly about it, that this looks like it is less dangerous than the others. And in that regard, it has always been the case that the emergency measures and the easing was going to obviously subside if that was the case. And it is literally that. So as you try to normalize the global economy, as that probably happens, you've still got sticky supply side, you've still got inflation challenges. Most important of all, liquidity will simply be less plentiful. And that's what the markets face this year.
Peter, all the uncertainty means market participants don't know which way to jump. We've had a couple of upbeat days, for instance, on the tech sector and on the US markets, and then volatility set back in. What do you make of the trade? You know, what's the best way to position at this stage around what's going to play out?
Yeah, the most difficult thing is that growth value. And Jeff earlier alluded to SAP. It's a great example. It is one of the rock stars of the tech sector in Europe. And it does exactly what growth managers will continue to say. We're the winners. You know, in this case, it's cloud. We're the winners. We're the disruptors. By us. On the other hand, rising bond yields mean the ratings on those highly rated, those stocks that have got a high rating, come under pressure. And if you talk to growth managers, as we have done at the start of the year, particularly in the US, that's the thing they're most worried about. It's not that their companies are, the horses of the apocalypse of '99. They aren't Dell and Cisco and whatever. They aren't the new fangs, etc. Aren't those? They're growing their earnings. They're growing the cash flows. But they're on, fairly punchy multiples. And if we're going to get higher bond yields and you're going to get lower equity ratings as a result. So, Karen, you're absolutely right. It's that almost schizophrenic behavior. So you tend to default to what you know in a more unstable environment. And personally, I said it, I think, in November to you, by income orientation. It has been a good strategy in December. It did work. I think that's one way to try and defend. So that isn't necessarily growth or value. It's who's got nice free cash flow with not too much leverage and that isn't too expensive. And that's where the tech sector tends to fall down. But that first week of the year was vicious, was it? Banks up 8-9%, tech sector down 5%. It took a lot of people out. And that's the biggest other problem I've got for the tech growth sector, particularly. Everyone's crowded into it. Global investors are in it. The hedge funds are in it. The margin debt is in it. It's the biggest problem it's got. It's very technically flawed in terms of positioning. Everyone owns these stocks. That is a problem for them. And that's very reminiscent of '99. It's where there is a similarity. The crowding effect in them is substantial. That's the problem for most managers at this point.